Good afternoon, ladies and gentlemen. Today we're going to be looking at various signal charts to determine whether or not we could be due for a bounce, whether that's a big bounce, a short-term bounce. We'll talk about it. We're going to dive into the Bitcoin chart. More specifically, we're going to talk about the Saylor to shift tool, where we stand with that. We're going to go into market conditions, which we do every episode. Incredibly important stuff here. And then we're going to dive into expected moves, another thing that we talk about every episode of the Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intra-market analysis. If you haven't done so already, leave a comment, hit the thumbs up, subscribe to the channel. That's how this channel grows. It's greatly appreciated. Also, big thanks to my partners, Interactive Brokers. If you haven't checked them out, please do so. The link is in the description and the pinned comment. Check out their campus. They offer all types of cool resources, including finance courses, beginner to advanced. And of course, thanks to my Patreon group, which, by the way, one of the things in the query channel, and one of the benefits is the comprehensive set of trading tick bots and the query channel. And I'm going to talk about one of those specific charts in today's show. Let's get into it. All right, ladies and gentlemen, welcome back to the show. This right here is not necessarily a signal chart or an indicator. It's just a quick way to determine whether or not we're seeing relative strength in more of a safety type trade. So in short, what you see here, all these little lines on these different products, these are relative strength lines. And the asset is relative to the S&P 500. So when the line goes up, whatever the asset is, it's outperforming the S&P 500. In this case, these are all more well-known as safety type trades. So we got gold, we got utilities, we got consumer staples, we got TLT, we got healthcare, and we got POWA, which I think used to be DEF, was the ETF, more of a defensive ETF. And what you're noticing here is you're starting to see the 50 EMA, that blue line, on pretty much across the board, start to flatten out and turn up. So in recent trade, we're seeing a little bit of that rotation, that money flowing into more of a safety trade. Consumer staples, gold has been big. Utilities has been seeing some strength there too as well. And this one over here is TLT relative to the S&P 500. I'm going to show another chart there in a moment, but I do find it quite interesting that we actually haven't crossed above that 50 EMA. Well, I mean, in a very long time. This is dating back to 2024 into and around what? That was September, late September. So we're starting to flatten out and curl above that. And what does this tell us? It means that there's a movement more into bonds. And typically that's never the case, right? Bonds don't typically outperform the S&P 500, but they do typically when there's typically more fear in the air, so to speak. You have healthcare that's doing well, and then you have some defensive sectors kind of going flat, okay? All that to say, what does today look like? Well, guess what? Today we had healthcare outperform. We had some real estate, financials, consumer staples. So still more of that kind of defensive rotation, where towards the bottom of the list, what do we have? Well, we had technologies, utilities also taking a little bit of a breather, which was more risk off, but this one's coming off from actually, why is this one selling? Well, because it went up, all right? But technology has been the one that's been getting rather hit. Which brought the S&P 500 down about 50 basis points, the NASDAQ 1.21, and in the NASDAQ 100, 1.21% there too as well. Small caps also took a little bit of a hit. Now, something interesting that I wanted to talk about was if you're trading this intraday, right? If you're looking at the market intraday and you're trying to buy these dips, this tool is probably one of the more important tools that most retail traders should have a good grasp on. Once again, this is in the Discord channel. It's part of, it's at Trading Tick. So you can buy the Trading Tick service. It's like 70, 80 bucks. My thing is like about $9. And you can just go to the query channel, type it in, and boom, it pops up this chart. You got this momentum, and then you get cumulative net premiums. But what is this telling me? Well, the red line, right, was above the green line. So this is the cumulative net premiums of puts for the market. And then you have the cumulative net premiums for calls right there. You have the zero line, goes across the screen, right? You have, you had positive on the cumulative net premiums for puts, negative there on the call. So this in and of itself was telling you, hey, today could be a bearish day. We can see more chop. It's not what you typically want to see if you're trying to buy the dip, because a lot of the times it can get faded. So Friday, it looked like this too, but it was even more bearish. These things were diverging completely. What happened? Well, take a look at the Qs, right? The Qs started the day positive, right? We had this little gap up here, and then it started reversing to where? Well, into the expected move for the day. These levels were shared on yesterday's video. I'll update you to show you what the new ones are. We rallied up higher, and then towards the end of the closing session, we had a little bit of a slip off. So the market's coming off a bit, right? That's funny because in yesterday's video, I was like, what I don't want to see is a gap up, doodle around, or an inside day, and then cut down, right? I'd like to see a gap down lower, flush people out, get people scared, and then see the rally. So unfortunately, we didn't get that, but maybe tomorrow, right? We'll talk about that. So what are we seeing? We're seeing a lot of these divergences that we played that really kind of led me to the conclusion that we could see some sort of a bull trap where the market went higher, broke to new all-time highs, came back into this very choppy range. So the Nyesi-McClellan oscillator, this is the traditional calculation. This is just a really quick way that I can say, hey, things are pretty overbought here. Things are pretty oversold. Or the market's pressing higher, but we have a negative divergence. Or, right, the market's going lower, but yet there's a positive divergence. And you can see, I marked them all out, right? I've been sharing this for, years. It's been a helpful tool to navigating specific turning points or potential turning points in the market. So we talked about this divergence. Well, it played out a little bit to the downside. Still not an oversold reading here. So what does this suggest? It means that if sellers really kind of step in, we might see that minus 250 reading at some point. It's no guarantee. It doesn't have to go down there by any means. We can start getting strength right away. But if it does come down to this minus 250, minus 300, that is in and of itself typically more oversold condition. You can see that down here at the bottom of this chart over here, as I'm kind of messing it all up. This is the NIMOT over here. You can see it's under 0. And when it's under 0, that's already more of a bearish thing. You want it to be positive, moving higher, and or you watch these oversold conditions. This is the summation index. Another way to look at this market and potential turning points is applying a parabolic SAR to the summation index. And when you get these little upticks or downticks, when it starts to change, it tells you that, A, there's a potential change in trend taking place here. So I'm just going to go ahead and mark these out on the chart that you've seen in the past. We're going to go ahead and draw a line straight up. And what did you see? Well, we started to see, let me draw that a little bit better. Over here, the market started to signal, hey, we could potentially see a change in trend to the downside. Well, what happened? Well, the market went up and it went right back down. It wasn't until around this point where we started to see, hey, we can see a potential change in trend to the upside. So if we draw a line, what do we see? Well, we saw the market more over here start to press up to new all-time high territory. And then we get this change in trend right over here. And what did that lead us to? It led us to some selling. Over here, we got some sort of a buy signal. That's right at about this range over here. And, well, we started to move higher. I'm pointing this out just because, well, we started to see a little bit of a flip here. And this could potentially tell us that, hey, we're moving into a potential change in trend in the Nyesi summation index, or there's a larger period of consolidation, right? Where we can go down, we can come up, we can go down, and it just chops around, goes back and forth until it gets some strength back. One thing that I called out a while ago was when we got this negative 300 reading, and you can look up, that was that minus 300 reading, and things got oversold, and, well, we bounced from those levels. But another interesting aspect of this is look at how it crossed under the 0 line at about the same time that we got a minus 300 reading. And that is something that I find to be quite interesting, because when you go back through history, let's highlight the times that this has happened in the past. So right here was the time that I just mentioned. Now we're looking back multiple years to 2018. And what you'll notice here is when you get those extreme readings and those crossovers like that, what has happened in the past? Well, you get some selling, and then it really didn't go anywhere for a while. Over here was in 2022, and then we led into that bear market. Over here was right before really the pandemic took a hold, and we saw that market sell off. Prior time to that was October of 2018, going into the, I forget what they call it. I'm drawing a blank, but the Christmas Eve massacre here, where we saw massive selling. And then over here in early 2018, we saw it too, where we saw a rally, then it came back down, and then we went up a little bit higher, but we really didn't go anywhere. So I thought that was interesting. Can you make something of this right now in this moment? Really, no. If you want to make more quicker tactical moves, you got to be kind of zoned in at like more extended areas that are quick hits. But I thought that was interesting, and I figured I'd share with it. Another divergence that's kind of been playing out a bit here was the housing market up here relative to the S&P 500, which is down here. And sometimes when you do not get the housing index X to really match what the S&P 500 is doing, these correlations, when they start to change and they diverge from one another over a period of time, it could lead to the S&P 500 resolving into that direction. So the housing market, right, didn't make new highs over here. The S&P 500 sold off. The housing market put in higher lows over here while the S&P 500 went lower. And that was a positive sign that led the market higher over here. And then the housing market over here, right, has been leading downwards, just kind of pressing down. And the S&P 500 has been pressing higher. And now we're just seeing the market pull off a little bit in a range, right? Let's not overthink it. It is a range. You have equal weight over here that has not made a new high while S&P 500 put in a new high. And well, that's not necessarily a good thing. So what happened? Well, we saw equal weight take a spill. The S&P 500 there followed shortly after. These are divergences resolving themselves. So another thing that we like to look at is just back month versus front month volatility. This is getting a reading at about 1.04, slightly higher. When we come down to 1.0, which we've seen over here on some quick hits, these can mark potential bottoms, capitulations, periods of digestion, and so forth. So this would suggest that, hey, we could still potentially have a little bit more downside. Now, it doesn't need to reach down here, right? It can turn right back up. That's always a possibility. But why is this important to watch? Well, because if it does come down there, it could give you a little bit more confidence that the market can be moving into a period of consolidation and find some sort of bounce. And you can pair this well with some of the expected moves. If we take a look at the percent of stocks above the 20-day moving average in various index products, we got the NASDAQ, the NYSE, the NASDAQ 100, the Dow Jones, S&P 100, 1500, mid-cap 600, and the S&P 500. Now, when we get down to these minus 15, minus 10 type readings, that's when it's like, okay, this thing is pretty cooked right here. That means that there's 90% of the stocks in these index products or below those 20-day moving averages. So right now, we're not really overbought, oversold. It still suggests that we can go lower and or turn right back around. So you want to get a little bit more aggressive and really start to look for things that have been shaping up or things that have been holding strong if these products start to slip and get into these very oversold conditions. Now, on a good note, interestingly enough here, we saw this out on today's live stream, but if you look at HYG, right, we'll call this the smart money bond market. Those are where the smart people trade. That's where the big dollars are traded. SPY, we'll call this the dumb money, right? There's smart people that trade SPY, but we'll call them the dumb money because we're talking retail type trade. Now, when I see smaller divergences on like that little 60-minute time frame, right? You can use whatever time frame you want. I'm just putting it on the 60 time frame right here. But take a look here. What you'll see here is as the HYG down here in 2023 in November, it was putting in a higher low. So smart money was like, hey, we're moving higher, but it was diverging from the S&P 500. And the S&P 500 started heading lower. Now, what does this tell me? Well, it tells me, well, smart money is not really buying this sell-off in the SPY. And this means that we could potentially, right, keyword, see a turn in the S&P 500. And well, we rallied higher. We started getting more volatility in 2024 in April, right? And HYG started to flatten out and put in a higher low. S&P 500 actually went down lower at that same exact time. So smart money was once again saying, hey, you know what? We actually might see the S&P 500 go higher here in the very near future. More recently in 2025, right, in 2024 to 2025, we saw the S&P 500 put in a new low. We saw a higher low there in HYG that led and resolved the market higher. And I'm bringing this up now is because the HYG has been just kind of, and by the way, we talked about this when it was happening. You can go back and watch those videos or find it somewhere. I don't know where it's at. It's there though. HYG has been consolidating, getting very tight here sideways. And you can see we have a low and a higher low. It's just been pressing higher. So the bond market, or if you look at HYG as the proxy here, high yield corporate bond ETF, it's not really scared of what we've been seeing like on Friday or even today, because today it was up. It was up 0.13 basis points. But the SPY was selling off. So once again, is the smart money telling us something, or is the smart money going to resolve itself lower and break down? Right? We don't have that answer. But what we do know right now with the data that we do have, the smart money, in this case, high yield bond ETF, it's not really worried about this price action that we're currently seeing. And we talked about that yesterday a little bit when we looked at like the volatility curve, how it was not in backwardation, right? Everything as far as the volatility curve goes, it looked fine. Okay, here's another interesting one. This is the relative strength line between S&P 500 and TLT, and it's typical for this thing to go up. It means that the S&P 500 is outperforming the TLT. However, if you apply an RSI to this line, meaning that if things start to get down to minus 30 on an RSI that's considered oversold condition, right? What does that mean? It means that the TLT all of a sudden started outperforming the S&P 500 relatively quick, okay? It moved in a rapid direction where the TLT started outperforming the S&P 500. And we're actually reaching this low point here. It's a new low on the year on the RSI, and we haven't actually been here for what, like 5 or 6 months? We got 1 month. Let me see here. We got 1 month, 2 month, 3 month, 4 month, 5 month, about 6 months here. And what you'll notice here is when we did get down into these areas, if I just draw a line up, what happened? Well, the S&P 500 actually saw some volatility to the downside. So we're kind of reaching into these extreme levels from this relationship. Over here, you can see that we reached down to like a minus 20 reading or whatever it is over here. And that was in August, right? I was on vacation right then, but it got to a pretty extreme level there as well. And that marked a bottom. Other than that, I mean, you can go back to over here, which wasn't really a low. It was kind of more sideways price action, then went higher. So TLT was doing good. But then the other oversold area was over here, and that marked that little March low in 2023. So it's not the greatest means of an indicator by any means, but it can give you an idea when this relative strength line, it's getting a little frothy. And I'm just pointing out that we're at a level that we really haven't seen for a while. And this is all happening, what? Just to tell you that the S&P 500 has been trading in a range, right? We broke out to new all-time highs in the SPX, not in the adjusted contracts for ES, but in the SPX, we did break out to new all-time highs, and we're right there at that middle of the range. So even if we slip off into 5,900, I know people, right? This created some fear and uncertainty. So a drop lower down to 5,900 is going to, that would create some uncertainty and fear and all that good stuff, bad stuff, whatever you want to call it. But in all reality, I wouldn't be scared down here by any means. We're just in a range. It's until we start really breaking from these ranges is when we can have that decisive move. So a move down into these levels, I mean, they could be opportunities when you will have a range-bound market or a larger consolidation in a current range-bound market, and that's in an overall uptrend currently. Okay, so that's what we're looking at right now is some of the indicators, some of the signal charts, etc. Let's hop into Bitcoin, see what we got going on over there. So this is the Saylor to shift tool. We had a sell signal about 1, 2, 3, 4 weeks ago or something like that. Right, it was right around here. We crossed down. Now we're seeing actually this sell signal in its worth, right? How we're actually seeing the market not being able to go anywhere. It's coming off a bit. Why is this? It's because gold is outperforming Bitcoin. You got a safe haven asset, low beta, typically lower beta, outperforming a higher beta, risk on type asset. The rate of change slipped into negative territory. The weekly price action crossed through the prior week. Bam, sell signal, sell trigger confirmed. Now we're starting to see it kind of turn up, kind of going sideways. A buy signal would be if we close a week above this rate of change of 0, and then we'd have to see price action confirm it, which we'll talk about on another episode when it comes up. But we're seeing it kind of slip off, and if I pull up just, a chart of Bitcoin, we've been really just kind of walking the plank over here, like to be quite frank. It's like, this is the ship, right? The ship of Bitcoin. And we got the little pirate over here, and it's like poking his little sword at us. And we're just walking the plank, right? We're not being able to bounce and jump away from it. But man, you walk the plank and then bam, we flushed. We're doing a quick little flush here in the after hours. This can get recovered quickly. However, I did apply a VWAP down here at the August lows, which is this larger consolidation, just to see where it might come to. And it came in to around 85,000. So I went ahead and set an alert for whatever reason, if Bitcoin flushes down there, that could be a level of interest to pay attention to. So I just want to be alerted if that's the case. So we got some distance from there, and this might turn around for all we know. I couldn't tell you, but we do have what's the potential of this being a double top, negative divergence. We do have the Bitcoin to S&P 500 relative strength line getting below that 50-period EMA. So you got the S&P 500 right now outperforming Bitcoin. That's not the greatest sign for Bitcoin, right? If the S&P 500 is doing better, Bitcoin is supposed to lead the charge in these type of risk assets. So if S&P 500 is outperforming, and that could be to the downside, S&P 500 performs better if they're both falling. It could be the case. It's not really the greatest sign. You could see when Bitcoin's outperforming the S&P 500, when this line goes up, well, that was boom. We saw a massive, massive move there in the price. So I have a couple of alerts set. Right now, it's just going sideways. I'm looking for some confirmations or some significant sell side action to potentially take part in it. Let's take a look at some of the market conditions going on right now. One of the more important things to, always pay attention to, because this really does help you take your foot off the gas, put your foot on the gas, depending on what type of trader you are. Swing trading, right, is different from day trading. Day trading is different from swing trading. Swing trading is different from investing, and so forth, right? So conditions of the market can really help you kind of determine what strategy to be in. So right now we're under this gamma flip line. When you're under the gamma flip line, this is one thing that I look at out of two things total for determining market conditions. So right now, what we saw the break its all-time highs. We came back in 5,900's down here. It's an interesting level from a gamma perspective. So if we come down here, people are going to freak out, but we're not going to freak out. We're going to look at all this down here as potential opportunity for the market to turn back and slingshot us back up. That's what happens when you're in negative gamma territory. You get selling into selling, you get buying into buying, you get some two-way volatile price action. And that's what we watch. When you're above the flip line, that's where volatility comes in. That's where volatility goes to die, right? Where the dealers look to buy the dip, they sell the rip, and you just get a constant grind, slow grind higher. Traders are all complaining, but the breakout traders and the people that understand this love it, right? So you just got to understand these conditions. So right now, where are we? Well, we've seen some pretty significant sell side in just a couple of days here, right? So it's significant in the terms of just quick price action to the downside as we approach some important levels. And it's all happening under the gamma flip line as the VIX has rose for a couple of days there. Okay, the next thing that I look at is the direction of the 5-day moving average. These started to flatten out. They started to turn yellow, right? Flatten out, turn yellow, gave us the warning signs, gave us the caution to say, hey, you might want to be a little careful here. Well, we started to see this sell off. So all of these are below those declining 5-day moving averages. This is something that, once again, I got to just keep calling him out because he's been very influential in a lot of my work. Brian Shannon, I got both of his books. I got to meet him over in Vegas. Just overall a great trader, great guy. I put the red dots up here. Why? It's because they're all below those declining in intraday charts of the 5-day moving average, okay? The 5-day moving average, right, on the 30-minute time frame, it's the 130. I'm sorry, on the 15-minute time frame, it's the 130 period moving average, and then the 65, I can't remember. I think it's the 65. Just do 1950, right, divided by 30, and that'll give you what this moving average actually is. And you can, the colors are just determining the direction of it, and if price is above it and it's inclining, it's green. If it's yellow, it means price action's diverging from the current calculation, and then red is price is below it and it's declining. So everything's red. So right now, what does this mean? It means that this is a more volatile period, right? One, we're below the flip line, more volatility typically. Two, we're underneath the declining 5-day moving average. Let the market try to resolve itself. Don't you try to fight the market. So in this current context, it's better for more day traders that have more of an active edge in a strategy, that like two-way price action or like to see this type of volatility. But if you're a swing trader, breakout trader, you're going to see a lot more fake outs, a lot more whipsaws. It's gonna. And if you're not prepared for that, you'll get a little confused, and that's totally normal. But if you watch the show and you continue to do so, we'll hammer this into you every episode. Expected moves. Expected moves give us an idea of what the market's pricing in for risk. Okay, it's trying to handicap that moving forward. If this is in my opinion, right, everyone talks about leading and lagging indicators. I feel like this is the best leading indicator for something that we actually have control of, which is managing risk. So in my opinion, this is hands down should be on everyone's screen. This is the daily implied move and weekly implied move. You can look at monthly implied moves if you want to, quarterly implied moves. I put all that on the Discord so you don't have to. I'm developing, now I'm working on honing it in, indicator that you can use in Thinkorswim, potentially even TradingView, that gives you the daily range out of the gate on any asset. It's actually pretty legit, if I do say so myself. I shared some of it on X. Okay, besides the point, SPY. SPY's daily implied range going into tomorrow is about 592.61. This one's based off of the options chain. This one down here is based off a calculation that I'm pulling from the VIX. And then we have our lower weekly implied move, upper weekly implied move. We saw some price action go to the downside, pretty much unchanged overall. I do want to call out that we did create a low, and these were higher lows here from a closing standpoint. And we do have a low reading and a higher low reading there on the RSI. So what do I want to see? I personally, I want to see this thing gap down tomorrow and just scream down into the lower implied move. That's what I like to see, because if that happens and market net flow is giving me some sort of more positive sign in the market, it's not like red up, green, and full red over here. If that's the case, I'm looking to buy the dip. Now, if that doesn't happen, we got to adjust and kind of play as we see fit. But that's what I would prefer from a bullish standpoint, is right out of the gate, gapping down, more sell side, people freaking out. That's what I like. But in the case that we gap up, which is probably going to be what happens again, this divergence will resolve itself. We bounce up a little bit, maybe come into these areas, watch the 5D moving average, how it's declining, right? It'll still be declining at that point, and it might take a while to resolve itself. So if this is the bottom, right? If we're not going down to 5,900, this is the bottom. We gap up. It trades up. Oh, okay, whatever. Trades up. This 5-day moving average curls around. We got earnings on Wednesday for NVIDIA. Bam, maybe it helps the market out. And then, hey, we start to see some higher lows build, and then we could play it from there, right? And it makes sense, right? This is being the tactical perspective. It's gonna require time to see where this goes. And right now, right, to guess it's kind of difficult. So if you don't feel like waiting, that's why I'm saying the other option, let's see this thing cap down and just go crazy tomorrow. And then we can go from there to establish maybe a higher low or play off some other key levels. If we take a look at the Qs, if we do come into the daily implied range for the Qs, that is back to and around now the lower weekly implied move. So come tomorrow, if we get more sell side, we'd be actually hitting the lower weekly move for the Qs. And on top of that, we're not like, this is last year's closing price of 511.21. So we had that positive divergence. If we do come off in here, I mean, this last year's closing price, we have tested this probably 4, 5, 6 times so far this year based on the 15-minute time frame. And if we do come down here, it's acted as a level of support. So it'd be interesting to see what price action might do in and around these areas if it actually even makes it to that point. If it doesn't, all right, we come back up, maybe doodle around the daily implied range. The 5-day moving average is coming in. We got to see what NVIDIA wants to bring to the table, right? Because that can change things obviously as well. Now, what's on deck? We do have some stuff coming out from nothing dramatic. We got some Fed talk. We got Case-Shiller numbers tomorrow, right? We got consumer confidence at 7 a.m. Pacific Standard Time, 10 Eastern Standard. And that's about it, right? Just some other little tiny things here too as well. So not too much going on from a macro standpoint. And then from a earnings standpoint, today we had TEM, Riot, Hims, Hers report after the bell. I don't know how any of it's doing. Probably not great. I'm interested to see what Riot looks like. I'm not going to pull it up right now, but I would imagine it's nothing too amazing going on with these names or anything that can move the market. Tomorrow before the open, we got Home Depot, Planet Fitness, some Keurig, some Dr. Pepper. And then the big one is going to be Wednesday, and that's going to be the one after the bell. And that has the ability to very well move the markets. We got Snowflake, AI, some Salesforce, some bigger names on that day. I want to take this time now to go into the Mag 7 stocks. So this video has already gone on for quite a while, but I'm going to talk about the Mag 7 stocks, where they kind of stand within their weekly moves, some of them, but they give you just kind of a broader picture because this is what's really kind of holding this market down. So if we take a look at the daily chart, this is ticker symbol MAGS. All right, MAGS, it's a MAG 7. And what we're noticing here is we've seen some very clean price action take place, right? These flags, breakout, tightness, boom, breakout, right? Markets move between contraction and expansion, right? We contracted, we expanded, we contracted. Now what are we doing? Well, we're starting to expand to the downside. So it's not a great look as we're breaking down from this with higher volume. But what I do want to say from kind of just a different standpoint here is that, yes, it's breaking down and we could very well head lower, but I want to comment that sometimes these type of moves can create bear traps and they can reverse. And sometimes these fake breakouts can resolve themselves to very fast moves. Whereas we've probably seen this before where we see a breakout and boom, it resolves itself very quickly to the downside. Okay. So it's always important to manage risks. Does that mean I'd be buying right here, buying right away? No, I'd still want to see strength. But if you have been bullish to Mag 7, you can pay attention to some of these charts. But if this starts to turn up and set back up, don't be afraid to start executing into this and looking at the risk to reward, how it sets up in that given time. But right now, we got some distribution taking place, right? These are breakdowns on some decent volume in the current context of this market. So let's take a look at the Mag 7. We'll start with Apple. I just want to call out the purple line. The purple line is the year-to-date anchored volume weighted average price. And then I want to call out pretty much last year's closing price. So what do we notice? We're above it, and well, we're below this. So we're down on the year in Apple. We're seeing a pretty strong move back, and we're above that year-to-date. So above the year-to-date volume weighted average price, that's positive. I'd like to see it consolidate, see what it does as far as setting up, but trying to take this little level out and see what it looks like. Remember, this price, pretty much around 250, they can act as barriers to get through. And after a strong move, yeah, you want to see it come in, maybe consolidate, and see if we can actually substantially break from that. NVIDIA, right, saw just a ridiculous move right to the upside, and it's creating what? It's creating a higher low, a lower high, sorry. So boom, 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 right? People got super excited, right? This is, okay, this is a great example of a move that can resolve itself higher, right? We had a strong move to the downside, contracted, broke down, right? It broke down, oh, fear, 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 and then it reversed itself, and from that fake move came a very fast move. So that's kind of what I want to point out there. Now, as far as year-to-date goes, guess what? NVIDIA, we're down year-to-date, and we're below the year-to-date VWAP. So right now, we're moving into earnings. Is it going to save us? Who knows? A lot of these big Mag 7 stocks, a lot of earnings, they've all been kind of, they looked good at the beginning, then they reverted, or they started gapping down, they sold even more. So it hasn't been looking all too hot, but we'll see here if NVIDIA can help out the market. This is going to be a coin toss. I'll probably be streaming it live, so make sure to keep an eye on that. Now, if I look at the 15-minute chart, I want to give you the weekly implied move. It's down here at about 121.10. Now, this move, right, it's gonna be more important as we get closer to earnings, so Tuesday, right, or Wednesday, right after the bell, or right before the bell ends. I'll look at what the implied move is. But if we do come down into here, this is what the market priced in, knowing that earnings was here, and that's down there at 121. So if it comes all the way down here, I feel like the market would be kind of front running what's to come on earnings, and then maybe we can see something more positive take place in NVIDIA. On the flip side of that is if we came way up here and then we started reporting earnings, the flip might happen in that case. Now, that's just narrative, but it's something to pay attention to. Another thing is I wanted to call out that this big run up right here, right? This is the month of February. This was February. Okay, we gapped down, we ripped up higher, and look where it came to. This right here, right there, that level, bam. This was I pulled this level when? I pulled it at the end of January. This is the upper monthly implied move for February. Where did we come to? We ran right into that level, we doodled it around, and we started coming back off of that level in recent trade. So pretty impressive stuff there. Let's take a look at Microsoft. Microsoft is what? We're below the year-to-date closing price, last year's closing price, so we're down on the year, down below the year-to-date VWAP. It's kind of a strong move to the downside. So yeah, you'll probably see bounces in this, but just note that it's not all that great. So if you want to be tactical, look at the smaller time charts. But right now on the daily chart, it's not the cleanest setup. If we take a look at Microsoft and we want to go into the intraday chart, we're below a declining 5-day moving average, but the lower monthly implied move is about 393, and the lower weekly implied move is 397, which we almost came down to today. We're kind of flagging. So if we get hit and come down into these ranges, these could create opportunities for those buy the dippers or people that are looking for important levels that are derived not just by a line on the screen, but it's from mathematics, right? It's from the options chain that gave us these implied risk levels. Amazon also, where did we close last year? Right over here. Where are we? We're way down here. So we're down on the year, down well below the year-to-date VWAP. And you can see here, why is the VWAP so important? Well, here's a great explanation and great reason to keep an eye on it. When we broke from it, it's telling us that the average person for the year, even after this nice run up, started going to their average price, right? The average person was at their average price, and people are like, I'm just going to start getting out of this. And it creates what? It creates some sort of a capitulatory move to some extent. So some levels that I'm watching here, I took a little position in on this, around this gap fill over here, but it's a very small position, not portfolio moving, because I think that we can see some sort of a bounce in the near future, but I'm also looking to potentially scale it if we can go a little bit lower, right? So we have this trend line down here that you can see multiple low touches. This is actually part of a flag pattern that I did play. So if we come down into here, then we have this gap fill. So in and around this range probably can produce some sort of a bounce. Maybe we get a little flush out and then the bounce, but that would be something that I'd be kind of eyeing in on. If we look at the implied moves for the week, we got about 209. So that was kind of the area that I'd be interested in down here. And we're already below the monthly implied move at this current time, but we are coming, this is the last week of this specific month. If we take a look at Google, same thing, right? This was last year's closing price. We're below it. Year-to-date VWAP, we're below that. We had bad earnings, right? Market didn't like, well, I don't even think it was that bad of earnings. I think the market just responded poorly to it. And, well, we had some continuation to the downside with really yet no bounce. Did look like it was getting tight right here where we could see the bounce. I was getting ready for it, and we broke down from that. So a level to watch is that inclining 200-day moving average in this gap fill. So if we get some continued sell-off, these could be levels that you can set alerts for, see what price does on a smaller time frame, and potentially create some shorter-term opportunities in these big names. If we take a look at the 15-minute time frame, apologies, the lower weekly implied move is at 173.79. We're below a declining 5-day moving average. I want to call out that in on Google, we are actually clear underneath that lower monthly implied move by quite some, right? This is up at 187. And then the weekly implied move is at about 185. Today, what do? We gapped up to and around the the 5-day moving average, and we started to sell off. Take a look at Meta. This one I put out on the trade ideas, and not really as like a setup that's ready right now, but this thing had like 19 days to the upside, straight green. Then it sold off, right? And it sold off to where? Right now, it's on the year-to-date VWAP. So here's where we closed last year. Price action's above it. The VWAP, we're right at it, right? After a strong sell. So if this can see some strength, this might create some opportunities. This might just be a pullback, right? To see potentially another move higher. So I wanted to call that out, right? We might undercut it, which we kind of did today. But if we do undercut it, we're still above a rising 50-day. If we make a little bit of a U-turn, then you have an idea for where risk can look like for a potential play back up to these highs. Create some really good opportunities in some of these Mag 7 stocks. If we take a look at Meta on the 15-minute time frame, today's selling action also not only did it came down to the year-to-date VWAP, it's right down there near that weekly implied move. Now, I want to call this out too. This is February, right? We saw a massive move, right? And basically straight up to the upside. Where do we stop at? Where do we stop at right here? We stopped right at the upper monthly implied move, and then we started to see price action slip off. So I think it's going to be a pretty interesting month up ahead. Like I said, for Meta, if we start slipping down into these lower territories, I'd be looking for some sort of a buying opportunity, shorter term buying opportunity, dip buying opportunity, smaller amounts, right? I'm not going heavy. And the reason why is because we'd be below declining 5-day moving averages, right? We're also we're in negative gamma right now. We're below these declining 5-day moving averages in negative gamma. That's where you can kind of take your foot off the gas as far as capital size goes, go a little bit smaller positions, but get a little tactical as well. That's all I got for you on today's show, everybody. Hope it helps out. I'll see you next.